Thank you all for dialing in. We have a large number of people who have registered and we'll just give people a little time to come into the room. Due to the large number of guests, we will not be taking questions from the audience and would ask that you direct all questions after the call to your CBA Relationship Manager. I would now hand the call over to Simon Hunter, Managing Director, Business Banking Sales for Global Markets at CBA. Please go ahead.
Good morning, everyone, and welcome. Thank you for joining us on this RBA Economic Update call. Over the last few months, it's been really important for us to be able to connect with you during these ongoing announcements, and we really appreciate you dialing into these calls. As a lot of people will know, the RBA rose interest rates again yesterday with a rise of 25 basis points, increasing the cash rate to 2.85, which actually brings us to the highest cash rate we've been at since April 2013. I'm delighted to have Gareth Aird join me this morning. Gareth is our Head of Australian Economics here at CBA. And as a lot of people will know, the big call last month cracked and again was on the money yesterday. Perhaps not as big a call, Gareth, but might be good to start with an overview of yesterday's announcement and perhaps where this sat with market expectations. Welcome.
Sure. Yeah, sure. Thanks, Simon. Look, good morning to everyone who's on the line. I hope those that got involved in Melbourne Cup yesterday had a good day. Of course, for economists and those in financial markets, Melbourne Cup Day is generally about the RBA board meeting. And of course, we had that move, as Simon mentioned yesterday, where the Reserve Bank increased the cash rate by 25 basis points at 2:30 p.m. As was generally expected across the analysts in the market, and then also in terms of what the market was priced. That all said, there were a few people still calling for 50 basis point hike yesterday. There was a few media articles circulating yesterday morning that the RBA might do 50 basis points, but they ended up delivering that 25 basis points in line with what we thought and very much consistent with what they delivered at the October board meeting. Of course, it wasn't just about the decision, it was also about the Governor's statement, and we got some updated views there from the Governor as how they're seeing this play out. I think it's worth keeping in mind that the 25 basis points they delivered yesterday took the total tightening since May to 275 basis points, which is an incredibly rapid pace of rate hikes in a very short amount of time. So they've delivered that over just 7 meetings, which is basically 6 months. They went 25 at the start in May, then followed that up with 4 50 basis point increases. And then in the last 2 months, they've slowed the pace of tightening down, but they're still moving each month. And they've moved by what was historically a normal move, which is 25 basis points. If we turn to basically the statement accompanying the decision where the Governor is able to articulate his thoughts as to why they did what they did, and it's very clear to us that the Reserve Bank is really cognizant of the lags between a change in the cash rate and how that impacts home borrower cash flow, demand in the economy, and then inflation. And what was interesting yesterday is that the Reserve Bank has upwardly revised their inflation forecast. So they're now expecting the peak of inflation to be 8% from 7.75%. And that comes in the wake of the stronger than anticipated inflation data out last week. And they've also nudged up their inflation forecast for next year. They're expecting it to be 4.75% over the year. And yet, despite that, they weren't willing to step up the pace of rate hikes. And the message there is that the RBA knows that the inflation data that we've seen over Q2 and Q3 this year, and for Q1 for that matter, albeit they didn't start tightening until May, but that data has not been impacted by their rate hikes. The way rate hikes work on inflation is to slow demand over time, and that's what will happen. But it does take a bit of time for that to happen. We've talked in the past about the lags between the change in the cash rate and when that hits home borrower cash flow. It's around 3 months. And then there's even a lag on that in terms of how people change their spending patterns and then how businesses respond to that through what they're doing on the prices side of things. So all of that takes time, and the RBA is very cognizant that it does take time, and that's why they've slowed the pace of tightening down despite getting that upside surprise on the inflation data. I think that's a really pragmatic move, because if they kept raising rates the way they were doing, and they kept going through next year until something broke, basically, that'd be an undesired outcome. And what the governor said yesterday is they've still got the objective there to keep the economy on an even keel. And that's really code for the RBA not wanting the unemployment rate to go up too much. Now, I think the RBA is delighted with the fact that the labour market is quite tight and that the unemployment rate is at a 50-year low. They're willing for it to go up a little bit to around 4%, but they don't want it to get much higher than that. And the only way they can basically achieve that objective is not to keep cranking up rates at the pace that they were before, and also not to take rates too much higher from here, because otherwise they will end up engineering a harder landing in the economy, which is something at this stage they don't want to do. They're trying to avoid that. I think the rest of the governor's statement was pretty similar to the one the previous month. It does read like in the end the decision wasn't that close between doing 50 or 25 basis points, and that they had pretty high conviction that 25 basis points was the right move yesterday. And I suspect because of that, you won't find too many people in the market now that are willing to call an increase in the pace of tightening at any meeting from here. Last night, the governor gave some remarks to a business group down in Hobart, and again he spoke around the logic underpinning their decision. Yesterday he talked about the lags. He talked about wanting to keep the economy on an even keel. He did basically keep full optionality there for future rate rises or the future path of monetary policy. He said there that the base case remains they take interest rates higher from here, and we've got another 25 basis point hike in our profile for December. But he did add to that and said, we're not on a preset path though. He said, if they need to step up the pace of increases again to make sure inflation returns to target, they're willing to do that. And he has said that in the past. But what he did add, and this is the first time he's made these remarks, he said, if the situation requires us to hold steady for a while, we will do that. And I thought that was a really big deal, because despite getting an upside surprise on inflation and upwardly revising their inflation forecasts, he said for the first time through this tightening cycle that they'll be willing to pause for a while if the data or the outlook makes the case to do that. And that's something we've been expecting. We're anticipating that they pause into next year to allow themselves time to fully assess the impact of the already delivered rate hikes, to ensure they don't take policy too restrictive and engineer that hard landing. I wasn't expecting the governor to err so early after an upside surprise on CPI that they'd be willing to pause, but he did that last night. And I think now you'll see that in their communication between now and the end of the year, just that they'll drop it in there that they're very conscious of the fact that global growth outlook's deteriorated. They've delivered a lot in the way of rate hikes, and I think they're setting us up for pausing at some stage in the not too distant future, just so they can take stock of what they've already done, and also cognizant of the fact that as we go through next year, there are a lot of home borrowers out there who will be rolling off ultra low fixed rates. They'll be rolling onto a much higher mortgage rate, whether it's floating or fixed. And so you'll get some natural tightening that will continue going through next year, even with the central bank on hold. So Simon, I might just hand it back to you there, and we can take this wherever you'd like it to go.
Yeah, thanks, Gareth. Look, a lot of insights there, and certainly I'll let you do the summary and pick up on those key points again at the end. But perhaps just where you left it there on housing. I know you've done a bit of research in the last few days around house prices. That will play a big part in this. What are you seeing by way of trends at the moment?
So much like the tightening cycle's been pretty rapid and pretty aggressive, the falls in home prices since the Reserve Bank began raising the cash rate have been pretty swift, particularly in Sydney. Prices are down more than 10% now from their peak, which was early this year, and they're falling at a pretty decent clip. There's an inherent circularity here. I mean, the reason they're falling is because the RBA has been raising rates very quickly. And we found out yesterday that prices across the country were down a little bit above 1% in October. But I think it's really the rate of change that's quite important. We're moving lower at sort of an annualized pace of close to 15% at the moment, and that's very much being driven by higher interest rates. Price outcomes are a little bit divergent across the country. The market in Perth is holding up much better than anywhere else outside of Adelaide. Both Perth and Adelaide are the outperformers at the moment. but all markets are moving south just to varying degrees. And I think the Reserve Bank is now starting to think more about the housing market in terms of it influencing their policy decisions, and not just from the prices side, but also how the increase in interest rates is basically hitting home borrowers that borrowed through the pandemic, where they took on these loans with very, very low interest rates. They were assessed that their capacity to repay the loan at a loan rate at a rate of 250 basis points above the loan rate. That's called the serviceability buffer. And now that the cash rate has been increased by more than the serviceability buffer, that means that you're going to have some households that took the maximum amount on offer. They borrowed that maximum amount, falling into what we would say is mortgage stress, where they're basically shelling out a big proportion of their income onto servicing the loan. So the RBA is really conscious of the fact that the housing market has an influence on the economy. Yeah, they said in the minutes a couple of weeks ago that monetary policy is having a clear impact on the housing market. And they said previous episodes of lower house prices and turnover had seen a large impact on consumer spending, in part through the wealth channel. So in other words, when prices start going south, people feel less wealthy and they're less inclined to spend. You know, that's a natural response. But then also when you get slower turnover in the housing market, which is what we're seeing, you get less spending on household goods. You know, generally when people move, they're buying new stuff to put in their home. So if you're getting that less turnover coming through, you're getting a little bit less spending too on household goods. So the Reserve Bank is conscious of all those dynamics. It's certainly not the only reason why they slowed the pace of tightening down, but it did feed into the mix there. And I think as we go through next year, what's going on in the housing market will be an important consideration into what they do on the policy front.
Thanks, Gareth. And then just bringing it back to inflation, I mean, obviously this is all linked, it's all pretty circular. We saw strong numbers last week. We see differences internationally in that, what's driving those inflation numbers in the US versus Australia. Just within Australia, the wage data, the wage inflation seems to be a different story to the US. And I noted that the RBA actually referenced our own wage data last week in what they're looking at. Is that a change? And is that an important part of the story that we're contributing to there, Gareth?
Yeah, it's a good point. The wages side of things is really important into how the RBA is thinking about inflation at the moment. And that also, you can see the correlation between wages growth and services inflation is quite strong. And what we've had in Australia up until this point is decent growth in wages growth, not though anywhere near like the levels that has been going on in the US, for example. And I'm aware that many people on the line who are running businesses will have experienced with their staff greater increases than what the numbers actually indicate. But the official data and also our internal data suggests that wages growth across the board is running at about 3% through the year. Now, there are certainly pockets where it's a lot higher than that, but there are also pockets where it's softer than that. And what the Reserve Bank does is set policy based on what's happening at an aggregate level. And our internal data suggests that wages growth is currently running at about 3% through the year and accelerating, but not running at the kind of levels where you want to take policy contractionary enough to actually drop the rate of wages growth. And that's something in the US where the Fed is actually wanting to do. Wages growth is just too strong there. It's inconsistent with their inflation target. And therefore, they're willing to hike more aggressively to get wages growth down. Whereas for us in Australia, wages growth is running at the levels not inconsistent with the inflation target, which is why the RBA doesn't want the unemployment rate to go up, because they're pretty content with what's happening in that space at the moment. Now, just to bring it back to what you said about our internal data, we've been using that for quite some time now on the wages front, because it's a really accurate gauge on what's going on, basically in real time, because we can track money paid into CBA bank accounts. We have a matched sample of around 275,000 CBA customers, and therefore we're measuring the hard dollars paid into bank accounts rather than kind of survey measures, which some of the other private surveys are doing. And the RBA has been watching that data, and they got in contact with me, and we had a few discussions, and that data recently appeared in official Reserve Bank communication a couple of weeks ago in a speech by Deputy Governor Michelle Bullock, So I think that was quite encouraging that the central bank is now using our data in that way so they can better understand what's going on in real time on the wages front. And the other thing which I think is interesting too is that Seek, which is obviously our main online job advertising platform, they have recently been running a measure on change in advertised salaries. And what that measure actually shows is that 3-4 months ago, advertised salaries through the year were running at 4.4%. And in September, they'd slowed to 3.7%. So there's some signs in the data there that even though wages pressures are still moving higher, we might be past peak tightness in the labour market. Seek also said that job ads on the month for the last 4 months have been coming off. And they also added this, I thought, quite interesting piece of information that the number of applicants per job ad increased 10% in September on the month. And if you put all that information together, what the labour market data is basically saying is that still a very tight labour market and job ads are still very elevated, but we're probably past peak tightness. If you're getting more applicants per job ad, at the margin, that means you're going to get a bit less upward pressure coming through on wages. And I think all of that ties very much into the immigration story. The borders are obviously open now. In the last 2 or 3 months, we've seen quite an increase in the number of arrivals from overseas. A lot of those people want to get a job, and therefore you're getting a lift in people applying for work. And again, I'll just sort of say that there'll be people on the line who will say that for their business that, well, what I've just said, it doesn't quite marry up, and that'll be absolutely the case. But once again, the RBA is looking at this thing in a total sort of picture, and that's what the data is indicating at the moment.
Right. Look, perhaps, Gareth, a really quick comment on this one. I'm conscious we had the budget last week, and there's been some commentary and coverage on that, but we've also seen elsewhere in the world that misalignment between monetary policy and fiscal policy creating greater pressure on the monetary side. Any comments from last week's budget and how that affects sort of future direction of the interest rate? Any change of view for the governor off the back of that?
Look, I think what we got in last week's budget for the near term was not a lot, and that's exactly what the government wanted to do, and I think that's what the Reserve Bank wanted the government to do. Basically, don't put any more money into the economy at a time when the economy is running hot. Inflation's much stronger than we'd like it, and we're raising rates to get that rate of inflation down over time. And the government was very much on board with that, which is why there wasn't any policy announcements really that kick in this fiscal year. The Treasurer had said sort of 3 or 4 weeks earlier than that to expect a bread and butter budget, which is code for don't expect a lot. And that's what we got. And I think the Reserve Bank was expecting that. The market was expecting that, which is why there was no reaction to the budget. The Reserve Bank obviously increased the cash rate by 25 basis points in October, slowed that pace of tightening down in the lead up to the budget. And then, of course, the budget just came in line with what they were expecting, and therefore, monetary and fiscal policy are working in a coordinated fashion right now, which is exactly what we want. And as you said, it's not what we've seen in other jurisdictions. I mean, the UK is the one that stands out there. They're very rare to see a Prime Minister last 44 days, but that's what happened given they were looking at pushing money into the economy at a time when inflation's red hot, and it's just not the right policy. I'll just say on the budget, one thing I think caught everyone's eye, though, not so much as a policy measure, but what the government said was that utilities prices for households are expected to rise by more than 50% over the next couple of years. I mean, that obviously adds to headline inflation, but that's a massive tax on households, particularly those at the lower income end of the spectrum who spend a greater proportion of their money on utilities. That forecast is basically on an unchanged policy basis. And I think what the government has basically done there is say, if we do nothing, this is what is going to happen to power prices. But I'm expecting the government to do something that then means we don't actually see power prices go up by that much. So they've kind of set us up, I think, for the no policy change basis, which is the worst case. And then you would expect over the next sort of 3 to 4 months that we hear something from the government around some policy initiatives that can actually mean that prices don't end up rising by that much because everyone looks to the government for solutions, not just kind of pointing out what could happen if they don't do anything.
watch this space on a policy response on that one.
Yeah.
Final quick question from me, Gareth. We'll have a lot of customers on the line who will be importing or exporting as part of their day-to-day business. Correlation to the rates story, but views on the Aussie dollar and responses to yesterday and short-term view?
Yeah, look, so, I mean, the Aussie dollar has obviously been bouncing around quite a bit lately, and like so many things, like in financial markets, there's just way more volatility than usual at the moment. Doesn't matter if you're looking at in the fixed income space, in the equity space, or the FX space, you're just getting much more intraday movement than normal. It was only a few weeks ago the Aussie had come off quite a bit, and it's rebounded recently. And fortunately, I don't have to forecast the Aussie dollar. That's to our international economics team, because I think it's a really tough thing to try and get right, because the currency reflects so many different things. It is a relative measure, so it's not just what's happening in Australia, and it's not just what's happening in terms of market pricing for the Reserve Bank. It's also commodity prices that go into the Aussie dollar, and they're influenced by global factors. And of course, the US dollar has a big bearing on the Aussie. Our guys think that the Aussie will fall a little bit more in the near term. That's sort of conditional on the Fed raising rates by more than the RBA, which obviously that's the house view. And then also some further weakness coming through in the global backdrop, which generally gets expressed in a stronger US dollar. So they see that near-term weakness coming through. But I'll just sort of add on top of that we're likely to see that weakness come through against the US dollar, but against other currencies, not so much. And that's because the view on the Aussie dollar is very much one that's reflecting a view on the US dollar, which is further US dollar strength. And, depending on where someone's importing or exporting from, they'll be more interested in the Aussie dollar cross to that currency. Of course, that's something that our FX guys and your team, Simon, can talk people through about how we're seeing the Aussie dollar against the other crosses.
Absolutely. Well, look, perhaps you covered an awful lot there, Gareth. Thank you. Loads of insights. If I was going to give you 30 seconds to say what's the key takeout or takeaway that people on the call should leave this call with, what would you leave them with?
Oh, look, I'd say that the Reserve Bank is really intent on running their own race as far as this goes. They're well aware that other central banks are raising rates more aggressively, but they're cognizant of the fact that we have some unique circumstances in Australia, like the composition of our mortgage market, like our high level of household indebtedness, like our softer pace of wages growth relative to other countries. And obviously we have a higher inflation target as well. And they really want to keep the economy and economic outcomes going through next year in a good place. I think the governor said it's a narrow path. I very much agree, but they really want to try and give it their best crack to ensure that we don't have a hard landing, that inflation will come down over time, and they want to keep the unemployment rate relatively low. So I'm glad that the central bank has taken that approach. It probably means if they get this one right, rates don't go up too much further from here. That's certainly our call. But at the moment, that's the race the RBA is trying to run.
Perfect way of finishing, Gareth. Look, thank you for your insights. The house view there around where rates are, the comments from the central bank around possible pause, but no preset determined path, and more than comfortable if they have to go up again, they will. A lot of volatility out there. Look, thanks everybody for joining us this morning. Thank you for dialing in. It's really important for us to keep these up to date calls regular and keep everybody informed. There's changing market conditions all the time at the moment. We're living through volatile times. As always, if anybody on the line would like to get in touch with their CBA representative, and we've got teams of people here that can try and help you navigate through these markets more. So thank you, Gareth. Thank you, everybody, for joining us this morning. Speak soon.
Thanks, Simon. Thanks, all.
That does conclude our conference for today. Thank you for participating. You may now disconnect. 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 You may now